Hi, welcome to Market in a Minute. I'm in our Fort Lauderdale offices looking at the Atlantic Ocean, and it's just gorgeous down here. We think the market will begin to struggle to make a new high. So it's very dependent upon the inflation numbers. We do have CPI on Wednesday. We'll see what that looks like. And then we are stuck with a seasonal pattern where the market really begins to struggle for roughly the next 6 months. And then what's bothering us a little bit, and the reason we bring this up is we've seen it before. We potentially had a currency crisis developing in Asia. The last time we saw a currency crisis in Asia was 1997 and 1998. I remember this period really well. The 1998 period, I was managing the Burger funds. One of my funds was up 50% at the end of the second quarter in 1998, and I just thought this is not going to turn out well. Then I was up only 20% in September, and then Greenspan came in, cut rates dramatically because long-term capital was going out of business and he needed to save the financial system. So I ended up that year being up 72, so it all turned out well. I just don't see that occurring again where we're going to see a rush to cut rates very rapidly if Japan actually has a big currency crisis. So the market update, as you know, we corrected about 6% from the high to the 100-day moving average in the S&P. Went back above the 20-day, that's good, above the 50-day, but we don't like when the 20-day is below the 50-day, by the way. But we're back close to the old high. Now, we need good inflation data to offset the valuation issue that we have to keep the belief that the Fed can cut rates as we go through the year. So in our opinion, we think the risk to the market is to the downside. We're entering a seasonally tough period, as you can see here. This is the next 6 months. The markets are kind of tough. They tend to go sideways and down through this period. So as we get into the election, we think there probably will be another buying opportunity in the markets at that point. So just keep in mind, if the print on the CPI, currently expected to be 0.3 to maybe 0.4, to come in somewhere around 3.4% inflation year over year, if that hits, then we're stalling out basically. If it comes in at 0.2, so we're closer to a 2% annual inflation rate, then I think the market's going to be pleased with that, and we will probably puncture through the old high. But it's probably not going very far, very fast. As we're into this seasonally tough period, and we do have high valuations, it's going to take a nice rally in the bond market, so yields in the bond market coming down. This is really interesting. So this is being proposed by Freddie Mac, that allowing them to buy second lien mortgages. So basically to get into the second lien business rather than just first lien, and still be backed by the U.S. federal government. So this would be agency paper, it'd be higher yielding, and it would cause problems in the financial system as there's a lot of companies that make these second mortgages. It would displace them. But you talk about a boom for the consumer, kind of concerned what it does in terms of the inflation. It will spark inflation again. But there's $32 trillion of equity in homes in the country. So this is quite the opportunity to finance some of that large amount of equity out there. We're going to keep an eye on this. There's probably some really interesting ways to play it. We think over the next several months we'll probably have an answer of what's going to happen there. By the way, Home Depot does report this week. Walgreens. So I'm a little embarrassed to say I own this stock. It's been the dog of all dogs, but we bought it well. We bought it when it was low here, and it's down to about $17. Had a nice little pop, got down to $17 and popped off of that level. Trades at roughly 5 times earnings. They announced that they are looking for a buyer for the UK Boots division. We were looking for this to occur as one of the catalysts. So there's no way, in our opinion, there's no way they're going to sell the UK Boots division for something less than 5 times earnings, probably considerably more than that. So we think it's accretive to the stock. This stock was $60 a share. It's come down in a big way, has a massive dividend yield to it. We think it's interesting. We don't think they have any financial risk of going under or anything like that. We think it's a great value down here. The yen carry trade. So here's why we're having this crisis. So what investors do, they short the yen to buy the dollar, or they short the 10-year Japanese treasury, or they borrow off the 10-year Japanese treasury, which yields currently about 1%, and they take that money over to the U.S. and buy the U.S. treasury that yields about 4.5%. So currently that spread is about 3.5%. That is historically really wide. So our markets have adjusted to the inflation we're seeing here. Our rates went up. Their markets have not. They do have some inflation, not as high as we do, but their markets, their interest rate has not gone up. So only at 1%, their interest rate should be probably 3.5% roughly, relative to our interest rate at 4.5%. Or maybe it should be a little bit less than that, maybe down at 3%. But you can see here the historical spread of their treasury, their Japanese 10-year bonds versus our 10-year treasury. So sometimes it's been less than 1% spread. Other times it's been as high as 3%, but it hasn't been 3.5%. So we're at a very high level. The Japanese need our inflation to come down much more than we do. This is causing a currency crisis in Japan. So if you look at their currency has declined. So this is the US dollar to the Japanese yen. So as this chart goes up, their currency is weakening. So the US dollar has gone up over 40%, $45 over the last 5 years. This has caused a big problem. The Japanese market economy has a huge amount of debt. So as their currency goes up, their interest payments have to go up as well. So interest rates have to go up. The Japanese came in, actually sold $35 billion of U.S. Currency to dampen the effect on their currency. So it got up to 160. They came in and sold a bunch of dollars. The dollar weakened relative to the yen. So we are very skeptical that the Japanese can pull this off, that they can weaken the dollar enough to bring down our currency to make theirs more attractive. So what's happening is that our inflation's too high. They can't bring up their interest rates high enough to offset the decline in their currency because they have too much debt. So they really need our inflation to come down. So you can see here, this is the Japanese debt relative to their economy. 255% debt to GDP. They're basically in a whole heap a lot of trouble. So if you look at this, they're basically they cannot afford to have their currency weaken, to cause more inflation, to cause their interest rates to go up. So they import a lot of energy and food into their economy. So as their currency weakens, their inflation goes up, and then their interest rates will go up, causing more and more financial distress in their economy. The one thing that we think that they can do, and it's their last tool, would be to sell off this $1.1 trillion of U.S. debt that they own. So that would be a very negative move for us if they did so. So why do we care? Japan is the 4th largest economy in the world. If Japan goes, you could make the argument that China's going to go too. Japan has the oldest population base in the world. The population has been shrinking for about 14 years now. It was 128 million people. They're down to 126 million people. and we see estimates that it's going to go down to, over time, to about 100 million people. So they can't grow out of this problem. This is a big problem. Now, natural gas. So we mentioned last week that we thought the natural gas was a way to play the energy needs for AI. And you listen to the technology executives, they want a renewable source of energy that's clean. Well, people in hell want ice water, right? That's not going to happen in any sort of time frame that's going to fit the build out of AI. So they're already struggling with capacity issues. As this occurs, we think more and more natural gas will be needed, and we think technically it's looking a lot better. So we formed a bottom here about $1.6 for natural gas. It's up to 2.25. We broke through the 20-day and 50-day moving averages, and it's headed off to the 200-day. We want to build a position in natural gas here. We think the best way to do it at this point is through the commodity, and we like BOIL, which is the 2x on natural gas. So thinking about all this, we do have a looming currency crisis. We don't think it's going to be of any sort of magnitude yet. These things take a while to play out. We would watch the $160 level on the US dollar to the yen. Much above that, we think it becomes a much bigger problem. And look out for inflation. If inflation stays hot, Japan's really going to have more problems. And our stock market's not going to go up if inflation continues to be on the trend that it is over the last 3 months, up 4.5%. So, we're in a seasonally tough period, high valuations, the risk to the markets to the downside. We want to be cautious going through here and pick our points, get some opportunities, take advantage of the opportunities that are presented. So thank you very much. Please hit like, subscribe, come to my website, Patrick Adams CFA, and sign up for a hard copy of Market in a Minute. If you ever need anything, just email us from my website. Take care.